Today I'm going to talk about some stocks and what you can do to learn more about stocks. So this is the stock market today. This is June the 1st, 2022. And as you can tell, some of these over here are some of the highest stocks for today, probably the most clicked on. My favorite one right here, gold, silver, there's US oil. Each one, when you click on them, will give you a symbol. So there's a symbol for silver, a CECS, silver. And each one will give you the current price of what it's at. So right now it's at 21.86. Each change every kind of 30 to 40 seconds. Everything goes up and down all day long. That's why some of these stocks are good to buy in the morning. Some are good to sell at night. It just depends on what the day brings and how the stock market looks. So this one is at 21.86. This is for the whole month, how much it fluctuated up and down. Here's a low point, $20.63. Then, here was a high point. A really high point, $23. Each stock, like I said, just rotates out throughout the day. See it today got up to almost $22, and then its low was $21. But that's for silver. But each one has a code on it that tells you what to look for in the stock market, and then you can buy it based on that. A good, interesting. Gold and silver don't really tell you the revenues that they make. As far as you could just buy all the coins and stuff, or the ounces for what, like $2,000, and then it is supposed to keep up with demand and keep up with the stock market. Gold and silver do pretty good because it's not like the metals. The ones for the metals ever go down. So it just fluctuates back and forth. It's not going to completely fall apart when the market falls. So that's a good... Copper's another one. Copper's a lot cheaper. It still is a precious metal, but you can still buy... See, you can buy 5 pounds of copper for $120. And it's a metal, so it's not going to deteriorate in value. It might go a little bit down and a little bit up because that's just the stock market itself. But it's never going to completely crash, and you're going to lose all your money. Let's see a good. I'll put in a bank. I'll show you a couple different stocks. Okay, this one is Bank of America. And right here, if you can tell, there's the symbol, BAC. So you'll put that in if you're trying to buy. And right now it's at 36.66 US dollars. And you can see how much it went up or went down today. And as you can tell, it kind of stays pretty level and then it goes back down. Banks are known to do this, go up and down all day long, and that's kind of what you want, especially when you're investing in stocks. The more risk you put into it, the more money you can make. It's all based on risk. I don't like to throw my money in huge risk. So see, that was a low for the last 3 years, almost $20. And this was the average. So it has a lot of options. And then here's another good feature that you can learn about whatever stock you're buying. This tells you their finances. It's public record. You can see it. This is Bing right here. And the income statement is how much revenue they produce after they pay everyone, after they pay for the building, after they pay for maybe office supplies, computers, whatever the case may be. So that's the total revenue right here at the top. The net income is after they pay for everything. So they made last year, or 2019, they made quite a bit in that first quarter at the end of the. This is for 1 quarter. That's quite a bit. And then their profit margin. The profit margin, how you get the profit margin is you just divide net income by revenue, and it gives you that percentage right there, 30.6. Then they have something called a balance sheet, and this is basically their bookkeeping for whether they have any debts. Let's say, purchase a new equipment, a new laptop, or they buy a new building. It's off credit, which credit is basically they're going to pay for it later on. And that can deteriorate a stock depending on how much debt they have. Obviously, every company is going to have debt, except for a few in the current market. So pretty much, but you don't want to have a lot of debt. That's the big thing, is when they have a lot of debt, their stocks deteriorate and they plunge to the ground. And then when they pay off their debt, their actually stock value goes up because they have more cash. Right there is operating, how much they made in operating expenses, their finances, whether they invest in stocks or what they do as far as investing. There's the investing right there. They lost 177.7 billion last year. Oh, that's quite a bit. And then here is their earnings, their actual earnings per share. So this is if you had a Bank of America share for that particular time, and they close usually once a year, 6 months. It just depends on the vary. You would have made $2.68 for each share you had. If you had half a share, then you would make that divided by whatever you have. So if you have half a share of this, that would be $1.34. So each one is based on that. Not all, and this of course is based on how much profit they make. If they don't make that much profit, you might get lower profits. You might get nothing. You could usually you don't lose money. They don't take money from you. But this is just what you get for investing and putting your money into their company. Let's look at another one. I love this one. Hawaii Airlines. Okay. Let's see. And by default, it will honestly give you, once you put it into Google, if you put stock prices, it'll automatically pop up. So right here is Hawaii. The symbol is HA. And you'll put that into wherever you're going to buy it. As you can see right now, Hawaii Airlines is on a plummet. It is going downwards. So they didn't have a very good day. But that's every company. Every company has good days. Every company has bad days. It's just like the luck of the draw. And you go from there. Some days you'll win money. Some days you'll lose money. It's all about how much risk you're throwing at it and how long you want to hold it to either make money or lose money. I don't like to put my money into risky markets just because I'm not, like I said, I'm not a big gambler. I like to play it safe. I don't like a lot of risk. I like to keep my money and make sure I keep my money because I don't like losing money. But I will take a decent amount of risk, but it's not a lot. Like infrastructure. These are all, United. United is UAL, and that used to be $50. I actually lost $5 on that when they plummeted. But it didn't drop completely. Some of these other companies, you'll invest, what, $100, $200, $300, and all of a sudden it drops to like $50 and you're out, $200 or something. I don't like putting a lot of money, like I said, in that because you just never know. So here's their earnings for United, and United is pretty stable airlines. I don't think they're going down anytime soon, which is a good thing because we need airplanes to travel places. I hope so. So then they have some other features that you can view online, and these are their finances for United Airlines, and that was a bad year because of COVID, and then it started coming up. Pretty given. Some of them see as they lost money there quite a bit because nobody was flying and, things happen. Here's that negative I was talking about. So their stock prices probably deteriorated quite a bit. They also got a tax credit right here because they lost money. So the government will give them money since they lost money. Usually, it just depends. But normally they will actually get money right here instead of giving the government money, which is very interesting for companies, that make billions and billions of dollars. Is if they lose money, they actually get money. They get a tax credit, and they don't have to pay any taxes at all. Very interesting aspect, like you and me, if we have a lower year, let's say 1 year we make 25,000, the next year we pay 45, and then we go back down to 25, we don't get a credit for that difference. We just pay based on what we made that year. But theirs is very different. Companies will get credits and stuff just based on this is how much debt they have, based to how much property you have. That's going to be equalities ratio is going to be the properties they have, or the assets they have, like airplanes, or which obviously this is an airline, so they have quite a bit of airplanes. But also here on the 2020, they also laid a lot of people off. So this number could have been a lot worse had they not laid people off because of COVID and everything. Here's another good thing to know about companies. You can actually see who owns them. So what companies invest in United, which is kind of interesting. I didn't really know this, and I don't know how accurate this is, but you can see top mutual fund owners, which mutual funds are basically, they give them money for a certain amount of years, and then they get a return on their investment, whatever the case may be. Here's the good things about the company. I can tell you a whole bunch of things. Like I said, there's a whole bunch of data out here. If you've never known about a company, it's at your fingertips. Everything about the company is right in front of you. These will even tell you the stock prices, what they were. See how the stock prices are fluctuating all day long. Between 57 and 59, it went up or went down 4 cents, and they fluctuate all day long. They go up and go back down, and go up and go back down, and go up and go back down. That's very interesting. Let's look at a more expensive stock. So here is Boeing. Boeing is a manufacturer for airplanes. So they make big commercial airplanes, and then they sell them to United or American or Hawaii or maybe a foreign company or whatever the case may be. And theirs actually has deteriorated. But it goes up and down. See how much theirs deteriorated? And that was probably right here. That was probably when they recall or landed the Boeing Max. One of their airplanes had an issue. And they got hit hard with that stock price, because nobody wanted to buy into them. As you can see, it was almost $400, $422 up here in March 1st, 2019, and all the way down here is 132. It's over at 132 now. That's a big decrease for a huge company like that. Some of them even paid $95. And that's the price you're going to pay. Let's say you want to buy it right then and there, and then you wait till when it's back up here. You're going to make all of that profit. Of course, you have to file for taxes and stuff based on that income that you just made. But it's not going to be till the end of the year. Then they'll send whoever you use, whether you use Robinhood, eTrader, there's a whole bunch of them out there. There's Merrill has one, which is Bank of America, basically, just a knockoff brand. And then they have Chase has one. I don't know if Wells Fargo has one. I'm sure they have stock options. Almost every bank has stock options because, they're trying to make money. And this is how they make money. You give them money and they use it for other stuff. Whether they want to finance somebody for a car or a house or whatever the case may be. So there's a whole bunch of stuff you can look at. So I've just barely even touched the surface. There is, so go to investing, and then you can see top stories. Oh, the market's, going up and down, whatever. People write about this stuff all day. Same with real estate. Real estate has been a hot market in the last 2 years because of the Trump administration put a tariff on steel. So now it costs a lot more to import steel from a foreign company or a foreign country. So the price of a house to build has gone up dramatically. And that's why the housing market is at a boom. Because of all these tariffs that the president imposed and has yet to remove them. Finally, when the market finally crashes, then maybe they'll remove the tariff and we'll be back to normal. Here's a company that everyone, I'm sure, knows this company. This company has been all over the place in the last 5 years. They are one of the new companies that makes electric cars. Tesla. They are in, last I heard, they were in California. I think now they're going to Arizona or something like that. But either way, it's the same company. Whether they, move to California or they move to Arizona, whatever. So, as you can tell, if you invested here at $66 a share, and now you're at $7.40, that's a pretty good time to sell. But let's say you were at right here, $1,114 a share. That's quite a bit. And then if it tanks, you just lost all that money. The government won't charge you for losses, so there is that. You just lost all your money, but you will not get taxed for that. And if you made extra money, like let's say you made $800 to $1,000, okay, so that's $200, right? So you made $200, and then let's say you invest again, like Las Vegas, you're just feeling lucky, and then you lose it, and you sell again at $846. So now you just had a loss. And you're only going to pay at the end of the year based off what you gained for that year. So whoever you use will automatically do that for you. They will send you a tax thing, and you just fill it out through whatever kind of tax service you use. Because, of course, you'll have to pay for that. to use that because they like to make money off of that when you do all these investing stuff. But another good one to point out, this is Facebook. Facebook actually doesn't pay money for buying their shares. So when you buy their share, you are going to get it for, let's say you buy it now, you get it for $188.64, right? And then, so they don't pay you dividends, which dividends are basically the earnings to give your money. Facebook doesn't do that. Last I heard. Maybe quote me if I'm wrong, but Facebook doesn't do that. I don't know why it says on here that it does, but Facebook has actually been one of the companies that don't pay dividends on their profits. Instead, you just wait for it to go up or down, and then you sell it then. And that would be your gain. But you can do that to any stock throughout the year. You don't have to wait. Let's say you buy it today at 5 o'clock, and you want to turn around and sell it at 7. You can. But that is either a gain or loss. Good thing to notice, what I have learned is if you do that, once you sell it, you can't buy back in until somebody else buys it, which, as weird as that sounds, you have to wait for somebody else to want a Facebook share. It's really odd how the companies actually hold it, and that is across the board no matter what company you use. I've used eTrader for it, I've used Merrill Edge, I've used Robinhood, Acorn. Doesn't matter. You're still going to have to wait until somebody else buys that share, that particular share, for either lower or higher in order to reinvest or get your money. And usually it's about a 2 or 3 day wait period. But you're still going to get the money that you sold it for. So if you sold it for $188.64, then you're going to get $188.64. That's just a very interesting thing that I've learned is they all have a wait period, even though you'll still make the money. Here's some other companies, like this is General Electric. General Electric basically make light bulbs, they make clocks, they make air conditionings, they make microwaves, they make this company didn't go down anytime soon. But something to note about this company actually has a lot of debt. And that's why their shares are lower than the average, like LG. LG is like at $300 a share. Samsung is at like $300 a share. Let's see, Samsung shares. Let's see, Samsung share prices. Maybe they're not listing them. So not every company lists them, but you just have to go from there. Let's see, LG. LG right there, as you can tell, look how expensive LGs are. I mean, $80,000. Holy cow. I don't know if that's in a different currency. It could be. But I don't know why it's so high. Because usually they're not that actually high. Because they want to, go to the average consumer. So here's Sony's. Sony is at $94.06. Sony makes, the PS4, the PS3, cameras, they make televisions, they make a whole bunch of other stuff, but they're only at $94. And remember what General Electric was at? $77. Because why? They just lost money right here. Look at all that money they lost. $6.77 billion. Gee, I wonder where that's all coming from. And each company tells you this by default. So I don't think they're going down anytime soon. But I mean, if there were a small company like a grocery store that just opened, losing that kind of money might be kind of severe. Yep, you can see right here, the debt ratio is a lot lower. And that means basically they have a lot of outstanding debt. This company has a lot of outstanding debt. Because, they're trying to do innovations. They are trying to make new microwaves so it attracts the market. They're trying to make new cameras. They actually went out of that market. They are trying to make new clocks. They're trying to make new appliances, dehumidifiers, new air conditionings. And all of this requires research and time and paying people big money to make a new product that attracts to the market to make people want to buy it. Because everyone knows who Samsung is. Everyone will go out and buy the new Samsung S20 or Apple or whatever it may be. The Apple new light bulb or something. Apple's always doing something fancy. They're always doing something. But each one actually, see, here's McDonald's. McDonald's, makes hamburgers and stuff. Even McDonald's, see how it's fluctuating back and forth? I don't think McDonald's is going anywhere anytime soon. But they still, people have, companies have to spend money because they still have to pay employees. They still have to pay, McDonald's, yeah, see how much McDonald's makes? McDonald's made quite a bit. Pre-taxes, so this is their income, and then this is their income after taxes. And then this is how much they paid per share, and then this is their tax rate. Each one's going to be based off their money that they make. And then it'll tell you what these are different kinds of stock options. One is probably going to be an employee stock option, where the employees can buy into it. And the other one's going to be the open market one, where you, me, that don't necessarily work there, but want to invest in McDonald's because we believe McDonald's for the future can automatically get a share of McDonald's.